Hello. Awesome. Thank you so much for joining us today. I'm Natasha, the CEO and co-founder of Cable. Cable is the automated effectiveness testing platform for financial crime controls. And I'm joined by Melissa Strait, the Chief Compliance Officer of Coinbase, and Brian Brooks, the former Comptroller of the Currency and now the Chairman and CEO of Meridian Capital Group. Thank you so much for joining us. We're going to have a conversation today. I'm supposed to moderate it, although knowing the two of you, I don't need to do much moderating. I think it's going to be a lively, opinionated, and energetic conversation. So let's kick off. And I think the first thing that we need to touch on, given the news at the moment, is what's happening with Synapse-Evolve, Lineage, Mercury. There are lots of news alerts coming out about it almost every day at the moment. A couple of the most interesting and perhaps troubling are that there's an $85 million gap between what the banks seem to have and what customers are thinking that they are owed. And that it turns out that Synapse may have mingled their own operating funds and user end funds. So I'm just interested to kick us off with Melissa. You don't even need a question. Go for it.
I was just going to say, tale as old as time, commingling client monies with your operating monies. It's a bad story. No, I actually think you should start with this one, Brian.
Well, to be clear, I was never a regulator of Evolve. Although you probably know there was a funny Coinbase story around Evolve, but that's not my story to tell. Here's what I would say. There's a really strong argument, and I tried to work on this when I was in government. There's a really strong argument that one of the most important roles of banks, and particularly national banks in the system, is to provide balance sheet and scalability for more nimble tech companies that can reach audiences that wouldn't be profitable at the bank level. So bank-FinTech partnerships are really important, I think, in the overall ecosystem of the economy. And if you care about financial inclusion, they're important to that too. The problem is you find one example of actual fraud, and then the entire model is gone forever.
There was a lot in the news over the past number of years about fintechs claiming they were banks on their websites. They're pretty good at not claiming they're banks anymore, but they are very good at talking about the amount of FDIC insurance that they can provide because of all of their banking partners behind the scenes. Does this issue, this disaster, does it put at risk fintech's ability to actually use banks' FDIC insurance in this way and provide that protection to their end customers?
I think not when done properly. I mean, the problem, as you pointed out, with Synapse and Evolve was just terrible risk management and potentially like outright fraud. But I think that, overall, the model, when done properly, executed with appropriate risk management, with responsible players, I mean, Coinbase benefits from that. All the other companies that I've worked for benefit from that with the proper structure. Can avail themselves of the insurance.
Yeah, I would say the same thing. I mean, what the agency leaders and what the political actors think is we can't allow real human beings to incur these losses. So it doesn't matter if you're a customer of a marketplace lender whose funds are held at, I keep saying Cross River, I don't know why, at whatever BAS partner, or if you're a customer of the bank directly, you're still a voter who lost money through no fault of your own. What they need is a throat to choke. This is what all government agencies ask themselves, is anytime something happens, there has to be a throat to choke. So if it isn't the bank, then it has to be a fintech. And the regulators think, well, I don't have authority over the fintech. Maybe the Justice Department does, but the OCC and the FDIC can't go after them. And so what they do instead is they go after the bank, which brings us to the overall topic of the conversation, which is if you're a bank trying to manage those risks and not be shut down, based on the Evolve precedent, what do? How do you show your regulators that your compliance program's robust enough that you won't have that problem?
I think if you zoom out in terms of like how we got here and what has happened, I mean, if you look at, and Brian would know this better than everyone, the banking ecosystem, right? What you see is you've got huge GSIBs, the JP Morgans, the Citis, the HSBCs. You've got your smaller regional community banks that are increasingly literally dying. I mean, their customers are dying. They're trying to find new revenue streams, and a number of them have gotten into this banking as a service, servicing fintechs, et cetera. I mean, why not, right? Looks like, everything's coming up the fintech these days. But what you find is that they just do not have the appropriate staff, the appropriate risk management, the appropriate expertise to oversee and manage these programs. And I think I've seen that kind of throughout my career. I tell a story way back. This is years ago, so I'm hopeful that this has changed since then. But I remember being in front of a banking partner and talking about our product, and I said, well, we were explaining how the KYC flow worked, and we said, well, have you downloaded it and signed up for the product so you can see? And they're like, oh no, we're not allowed to download it. We're like, what is going on here? I mean, if that is your corporate policy that you can't engage with these products, like how are you possibly in this business? So I do think times have changed. Maybe not as much as they should have, but I think that's how we've kind of gotten here, right? Is that a lot of the big players, they just don't have to deal with this, and they're not going to take a risk on some teeny tiny startup that wants to loan their license. It's just not worth it.
And that leads nicely into how do we think that, where do we think fintech goes from here? So with the consolidation of SVB and First Republic last year, and I think there were some number of thousand banks over the last number of years that have closed down, have been bought. We will continue to see that trend. We are also seeing the funding market for fintechs dry up a little bit, and fintech providers like Synapse explode. There are less fintechs, there are less banks. Is this just overall worse for consumers? And will that mean that actually there needs to be some path forged here that means that fintechs and banks can work together? Where do we go?
There's a lot in that question, and I think there are two specific things I want to sort of just press on for a second and talk about. So there is definitely the issue of, in this country we used to have like 8,000 banks, and now we have more like 4,200 or 4,300 banks. So people point to that and they say, well, that's an example of, the American model of banking is going away. We have a competitive, privately owned, marketplace-based banking system. Versus if you go to any country in Europe, there's no country in Europe on a population-adjusted basis that has as many banks, even as we have today. So I would argue that the number of banks is not necessarily a sign of anything. What is a sign of something, however, is the number of new banks. The number of new banks, on average, on an annual basis, post-crisis, is like one new bank a year. Pre-crisis, it was more like 30 new banks a year. So that's what's really interesting is, nobody who is an entrepreneur is thinking, what I'd like to do entrepreneurially is open a bank to meet the credit needs of some sector. Maybe it's a local community, maybe it's an industry sector or whatever. Nobody's doing that anymore. That is a sign of sclerosis. And when you add that to the recent statement that the OCC has made, which is that they're going to essentially not allow mergers that would create a bank that would cross the $50 billion asset threshold ever again. Think about it. Why would anybody want to own a bank? I mean, if somebody were to tell any of you in any of your companies, we've established it's an election year, so can I just say Marxist? Okay, we've established a command and control maximum success threshold, and we will not allow you to exceed the maximum success threshold. You'd say, well, screw that. I'm not going to take a risk. I'm in this because I want 100x return on my capital. And if you're telling me that the maximum I can ever do if I'm a bank is hit 49.9 billion and then I'm done, why would I do that? The answer is, and this gets to the fintech part of your question, the answer is maybe I don't care about growing my assets beyond 50 billion if I can scale my balance sheet through fintech partnerships. So M&A is not going to happen. Organic deposit growth might not happen, but revenues can really grow because they're markets that I may not be able to penetrate organically. It might be small dollar loans, it might be workforce housing. I mean, there are a lot of areas that traditional banks ignore that fintechs focus on. I can still be profitable as a sub $50 billion bank as long as I can lever it up using partnerships. That was my theory when we passed these regulations like the true lender rule, was the idea of making it easier for banks to grow that way versus having to merge. So I think actually there may be a fintech silver lining in some of these things, which is the only path for growth is that. Depending on the outcome of the election and the overall regulatory climate, that may or may not happen next year versus 4 or 5 years from now. But I think that's the logical place that lands.
Maybe I can add to that from, I think, the fintech perspective. I think it is getting harder to be a fintech in this environment. I mean, when I started over a decade ago doing this being working in fintech, you could have a small, scrappy, I think we'll talk about this more, small, scrappy little program. You're building the plane, you're flying the plane, and I think banks were fairly receptive to that model. They understood this was a growth journey. They kind of want to see the foundation, and then they're willing to kind of see you grow over time. I think that is increasingly not true and not going to be where the risk appetite of most banks taking on these players is. I think particularly in light of what's come out re-Evolve, the level of compliance and the sophistication of the program and the investment in the program is going to have to be pretty different than what we've historically seen. That's not to say that there isn't, room for a young fintech to have a really creative idea and pitch something novel, but I think that they're going to have to do that with kind of compliance fundamentals in the beginning. Hire the compliance staff. That wouldn't normally be a recommendation that I'd make. It's like an early stage company, of your first 5 hires, like get a compliance officer. Increasingly, that could be the direction that I think firms are going to need to go if they want to be successful and compete in the space.
I think when I moved from the UK to the US last year, one of the things that was most obvious to me was sort of in the UK, we have an e-money license, an EMI, and it means that any fintech in the UK would get an EMI and have their own money laundering regulatory requirements. And so one of their first 5 hires probably would be a compliance officer. And it surprised me very much that there was not a good equivalent to that here in America. So perhaps that's something that we might see.
Well, let me speak to that. So, I worry a little bit that the way I'm talking makes it feel like the world revolves around me, but like I tried really hard in my brief time in office to address some of these things, and everything I did was repealed on January 21st of 2021. One of the things I spent a lot of time talking about, and I really do believe this passionately, is if you think the problem is that fintechs operate in too lightly regulated an environment to be safe and sound, like if you think that the problem is that Evolve went down because their partner fintechs were screwing around, the solution is to bring fintechs into the banking system, right, and give them bank supervision and give them liquidity and capital requirements and things like that. And so, one of the things I talked a lot about as controller was the idea of a payments charter. Like, for example, if you have a company as big as Stripe, throughput of $150 billion a day and that kind of thing, why can't Stripe be a bank? And some people's heads exploded at that idea, and they said things like, "Well, you can't combine commerce and banking." And I said, "Well, but why is Stripe commerce? Stripe's a payments company. Every bank in America is involved in payment clearing. It's one of the 3 core functions of a bank." My thesis was, if you're involved in any one of the 3 core functions of a bank, you should be able to be a bank. Not all banks offer all the same products. Let's say Stripe doesn't offer checking accounts. So what? They clear payments. So one of the solutions, this is one of the reasons I mentioned how few new banks there have been over the last 15 years. There should be more new banks, and they don't have to look like JP Morgan. They could look like Stripe, why are those things not within the bank charter? That's a huge subject of debate and a lot of partisanship, actually.
Do you have any thoughts on that, having worked at Stripe and also at Square, which, of course, went and got regulated?
Yeah, I think, the existing money transmitter framework in the United States captures some, but not all, of the payments ecosystem. It really is like a product-by-product analysis. So even looking at the products that Square, now Block, has, as well as Stripe, even thinking about Coinbase, like not everything that we do is captured under a money transmitter framework. But I think for, it's expensive, right? You have to go every single state, do your state-by-state analysis. But I do think, the benefit of that, it's a somewhat lighter lift than a federal charter for, unless you're in New York, I think, or California or some of the other big states. But the benefit is that it's a centralized framework. You're not talking to North Carolina about their view, and then Nevada has a different view. And by the way, you're basically going to be functionally examined all the time, constantly, because every state has its own exam staff, and sometimes they coordinate and sometimes they don't. And that's not a ding on any of the folks that are working at the state regulators. That's just how the system works. And so while I think there are certainly benefits to it, it can, you can kind of have, a lighter lift to some extent from a compliance perspective. Certainly not the scrutiny that you'd see from an OCC or a Fed. But there is just the decentralization, I think, does not necessarily serve from an efficiency perspective. And you don't have access to the full kind of suite of banking services. Money transmission is like a very tiny thing, right? It's very, very specific.
Yeah, so there's one other thing you don't have, though, which really gets at Tasha's question. And that is, in Britain, when you have your e-money license, you can have access to the central bank. In the U.S., for all the supervision you might get as a money transmitter? And the answer is, it's actually, I mean, if you look at the failure rate of money transmitters versus the failure rate of national banks, it's an order of magnitude difference. But putting all that aside, money transmitters cannot connect to the settlement layer of the economy, which is the Federal Reserve. Only banks can do that. And that was my whole point, is if you purport to be clearing all kinds of payments or engaged in marketplace lending, if that's your business, or buy now, pay later, any of those things, having access to the Federal Reserve through the payment system and the discount window, those two things, one lowers your funding costs, the other gives you ultimate settlement finality. If you can't do that, you will never have the kind of system that exists in the US, in the UK, and in a lot of other countries, by the way. I mean, we're very rare in terms of, we have lots of financial companies that are not allowed to connect to the settlement layer. It's bizarre.
Yeah, that is interesting. And I guess the problem with the e-money license in the UK is how you can't lend because you have to hold the money one for one. So there's pros and cons.
Right, but then you just get a bank license, right?
Well, then you get a bank
license. So
license.
there are multiple layers of how heavy do you want this to go.
Yep.
My theory was, of course, if you're one of these companies, why wouldn't you want to be able to lend? You'd want to take deposits because of the cheap cost of funding yourself. Anyway, maybe that'll happen one day. Maybe it won't.
And in the UK, it seems to me like the FCA might start requiring that some of the larger fintechs do get a banking license. There's been rumors that that's what they've been trying to make Revolut do, although I don't know that for sure. Obviously, I was at Monzo, where our plan was always to get a license from the beginning. But it will be interesting to see here in the US if the regulators do start to gently or not so gently nudge the largest fintechs towards that route.
I mean, again, not to get political about it, that will never happen in this administration, because they'll do the opposite. Like, rather than mandating a bank license, they will prohibit them from getting a bank license, which has been the posture.
So we keep trying not to talk about it, but let's just talk about it. What impact do you think the election could have on fintech and on banking?
I think it's going to be enormous in a bunch of ways. I mean, first of all, you'll see a day one change in the heads of all the agencies, which matters a lot, right? So you can expect a much more rapid descent to 2% inflation if Trump wins than if Biden wins. I'm not, everybody knows my side of this debate. I do have a view of which is the better economic policy side, but I can make the arguments for the other side. There are arguments, okay? But the things I would expect to see would be much more openness to bank-FinTech partnerships, obviously more openness to crypto. I mean, President Trump has been very vocal about that in the last couple of weeks. It's the flavor of the month, and he's picked a side. Unfortunately, his son Barron has apparently also picked a side. I don't know what that's about, but anyway. So I would expect to see a lot of that, and I would expect to see much more market-oriented approaches, which is when Yelena, Randy, and I were in charge of our respective agencies. That's what you saw coming out of us, I think, was we were very open to the idea of the profitability side of bank safety and soundness. We wanted banks to be profitable. We wanted them to use market forces rather than command and control to reach unserved parts of the market. We believe that was a much healthier way of getting credit where credit is needed, versus this administration is much more command-oriented. They focus more on Community Reinvestment Act, much less on marketplace lending. We thought the other approach was better, and I think the numbers probably bear some of that out. So I think that will change a lot. And I think you'll see an openness to new charters, which, it's been a long time since that happened. So I would expect at least those things will happen.
The wacky thing about this to me, as a person on the other side of the political aisle from Brian, is that to me, if you look at what the existing administration is protecting, it's protecting the incumbents, right? It's protecting your JP Morgan Chases, your HSBCs. Famously, Elizabeth Warren got up a couple of years ago and just absolutely handed it to, I think it was the CEO of HSBC, just raked him across the coals about the kind of egregious failures at the bank from a money laundering perspective. But the reticence to embrace crypto, to embrace fintech, to allow pathways for these companies, and like most fintech companies, their mission is to serve people who have not historically been served. I don't think it is a good outcome for the world for these huge banks to continue to kind of be able to call the shots, right? And to choose who they're going to bank and who they're going to de-risk. And there's no one really kind of credibly challenging that view. So yeah, it's unfortunate, and I would hope to see a little bit of a different perspective on the kind of current administration, but it is what it is.
So can I want to pick up on two things you said just as a footnote, because you raised two really important issues we shouldn't we should not gloss over. So one of them is the idea of who are they protecting? Like, who are the regulators supposed to be protecting? There actually is an ideological difference of opinion in the world, not just in this country, over whether credit is good. You know what I mean? So like when lenders go in front of Congress and say, look at all the loans, look at all the mortgages I made to minority borrowers or borrowers in low and moderate income areas or whatever, one side of the aisle says, great. And the other side of the aisle says predatory lending, because risk-based pricing of a loan to somebody with a lower credit score means they pay a little bit more than someone who has higher credit scores, and those things do correlate with race, education, and a set of other criteria. So you have to ask yourself, do you think credit's good? Okay, I would expect at the margins more credit, and especially more consumer credit, to flow, on one side of the election versus on the other side. The other thing I was going to comment on, you mentioned de-risking. De-risking tends to be a euphemism for, denial of icky industries for access to credit. And icky, unfortunately, in this context includes crypto. Okay, so everyone knows about the FDIC program called Operation Chokepoint back in 2012, 13, 14. And when that thing was, that was an operation where basically banks that were regulated by the FDIC were more or less pressured by their examiners to stop banking payday lenders, pawn shops, sex businesses, a set of things like that. But it was never done publicly. There was no legislation. And when it came out, it was a scandal, because it's like these businesses are all perfectly legal. Fast forward 8 or 9 years, and it turns out the government didn't need to pressure the banks to do that, because now a set of political ideas had permeated the C-suites of the largest banks, and they on their own decided to debank all these companies. So they debanked oil and gas companies because, climate change. They debanked firearms manufacturers because Sandy Hook. They debanked crypto because of Mt. Gox or whatever. And so one of the things we did when I was in office is we enacted something called the Fair Access Rule, which says you can't deplatform something that's legal. If there's a specific risk factor for the specific institution, like if this company is not well set up to manage the risks of oil and gas lending because they have concentration risk, or they don't have the expertise in their business or whatever, that's one thing. But you cannot say oil and gas doesn't get a loan. You can't do that. That was repealed on the first day of the Biden administration. And yet, weirdly, in this NRA versus Vullo decision that came down in the Supreme Court just a few weeks ago, the Supreme Court unanimously said that that's not an appropriate role of bank policy. You should not be enacting social policy, environmental policy, or whatever through the banking system. If you're going to regulate those things in a democracy, you have to have a law that the people's representatives pass. I think that's a really important thing that you could look to see debate on in the next few months.
We talked earlier about fintechs starting to serve, certain areas, certain consumers who perhaps have been underserved previously. There are a lot of fintechs that are quite narrow in their focus with regards to who they're trying to serve. And how does that play into risk appetite and this NRA decision? Is it that when you become a certain size as a fintech, that actually you have to accept anybody as a customer, even if they're not in that well-defined slice of the economy that you were trying to serve with your initial product? Or do you think that you can at all times argue that your product was I don't know, you created a fintech to bank dentists, and actually some farmers applied for bank accounts? How do you align that with risk appetite and also with the NRA decision?
Go ahead.
I think you made an interesting point on kind of the risk management aspect, which is it's just not taking a blanket approach. So it's not saying all oil and gas, but looking on a customer basis and making a determination that, look, we just don't have the right expertise for this, frankly, or looking at from a revenue perspective, right, and saying, maybe our dentist-based fintech, we're charging dentists $1,000 fee, and frankly, we just don't see the rate of return for the additional the additional lift that it's going to take us to bank farmers or to bring farmers onto the platform. So I think that it really comes down to just appropriate risk management, because there's no one would ever say, and the position we're advocating is not you must accept any customer no matter what. Right. We've seen what happens when that is true with some of these recent examples, but it's really, do you have the right level of sophistication of your risk management program to make customer decisions? And so as we're thinking about this at Coinbase, so I think we generally have, and Brian would know, our terms of service, we cannot provide services to you if you're engaging in illegal activity. That's the bar. There's some gray area, right, in terms of, well, how do you determine that certain types of activity are illegal? Is it our job to determine that they're illegal? We bake this into our policies. We have thresholds, we have standards, we have review processes. Like, that's what you have to do, I think, in order to kind of enforce what you're describing, right? And think about what your risk appetite is and the types of customers you want to take on.
Yeah, and maybe I can just put a little punctuation mark on that, because it's a great point. I mean, the way that I always thought about it was, it's one thing for a bank to say, we don't make oil and gas loans because we don't employ geologists, we can't underwrite that credit, we don't know if there's oil in the ground or not. There are banks who do employ people like that, and they know how to underwrite the credit. That makes sense. The theory of fair access, however, is if you offer a product, okay, you have to offer that product on like terms to similarly situated people. So one of the things we found is there were some banks that wouldn't make loans to oil and gas companies, but they also wouldn't give them a checking account. Now, wait a minute. You don't need to be expert to offer a checking account. That's not even a credit product. That's just a deposit product. You can't offer a checking account to the wind farm and not offer a checking account to this guy. It's sort of like, it's almost an offensive analogy, but it's very real. It's like Woolworth does not have to offer, ribeye steak at the lunch counter, but whatever they serve at the lunch counter, they have to serve to everybody, right?
Woolworth is a flashback to my childhood in the UK. I don't know what that is here, but is it the same?
Well,
Rights.
Woolworth lunch
then
counters
definitely
were a central feature of the civil rights movement in the 50s.
Yeah. There was a high street chain called Woolworths in England. I got very confused.
There was one in my hometown, and it was a low street chain.
Yeah.
Yes. It was otherwise known as the 5 and Dime.
Yeah, it's like a little, like what we now have is a CVS if it had a lunch counter.
Yeah, exactly.
Okay, good to know. So one of the things.
Aren't you glad you came? this is the best. This is the
the
best
type of
cocktail
riveting
hour you've had
content
today.
the audience is looking for.
I used to go to Woolworths to get my pick and mix.
Oh, yes.
Yeah,
I
was
know
what
what
I
a
went
pick and
to
mix is
Woolworths
because
for.
I'm married to a Scotswoman, but I did not know that before.
Oh, is that not an American thing either?
No.
No, we know it. Yeah, I know it.
Candy.
Yeah.
Yeah,
The
But you get to like
candy
choose
cup.
it.
Candy.
You get to like choose it.
My kids say candy in an English accent.
Moving on.
Sorry.
Some of us are leaving in 15 minutes.
All right. So one more question from me before see if there are any questions from anybody here. As we speak to banks, our customers, and some other prospects in the market, we keep hearing that the regulators are getting very, very particular that if there is something in your policy, in your procedures as a bank, then you will receive an order, an MRA, a warning at the very least, if you are not meeting that procedure exactly, even if whatever it is that's in your procedure is not actually a regulatory requirement. So what I'm interested in hearing your opinion on is whether actually that's been the intent all along, whether we are seeing more warnings, more orders coming out with this administration, and actually they're just trying to look for reasons to give orders to banks, or whether this is a good or bad thing.
So I think I've kind of two points on this. I think the first point is that this is how it's been all along. Like, this is what regulators are looking for, is that you set up your compliance program, you establish your policies and procedures, and what they are looking at is not only are those policies and procedures, compliant with applicable rules and regulations, but also are you following them? And because not following them is where the risk enters. And if you're not following them, well, maybe that's for a simple and easy reason that, well, maybe we just changed it and we forgot or whatever. Or it could be, failures of risk management, you have outdated documentation, are you actually appropriately overseeing what you're doing if, you have analysts that are operating on procedures that no one is actually following. So I don't think there's anything new here. You don't have to, from a regulatory perspective, draw a straight line from something that is not working to massive breach of the law that has occurred, right? They're trying to get in ahead of that happening and identify deficiencies within the program that would need to be remedied. I think The second point there, and I think this kind of goes back to our earlier conversation, I do think that we are seeing increased activity on the BaaS providers. And I think for fintechs that have various state-level licenses, money transmitters, et cetera, I also think those regulators are paying more attention. So perhaps companies that, frankly, have been flying under the radar, the regulators have been like, nothing to see here, looks okay, what risk are you really introducing, are actually completely rethinking that position and are taking another hard look. So I think it's a combination of those two things.
Yeah, the smaller community banks entering this space and getting a taste of what it's like to be regulated as a much, much larger bank for the first time.
I think that's true. I mean, the two things I'd add to that are, one of the things you saw with Silicon Valley Bank is banks can go from small community bank to giant bank in a really short amount of time. Like the funny story I tell about SVB was when it was 2 days away from failure and I was thinking maybe I could organize a group to buy it, I called up my friend Minushin and I said, hey, do you want to go buy Silicon Valley Bank? And he said, what's that? I said, it's a $200 billion bank. And he said, no, it isn't. And I said, it wasn't the last time you looked at it 4 years ago, but it is now. And we started running the numbers. So things can get really big a lot faster than you think, which is why Melissa's point really is the right one. The thing that regulators are looking at when they hold you to your policies and not just to the law is they're looking at the adequacy of your control environment, which is for any given set of rules, are you capable of managing the institution within whatever the rule set is, including the rules you give yourself? And the issue is, like, even if your policies are way stricter than the law itself, so technically you're not breaking the law when you're over here, what it tells us is when you get to the edges of the law, you're going to break that too, because you're not capable of operating in a safe and sound control environment. That's really what it's all about.
So really, banks need to focus very much on making sure that for all of their accounts and all of their transactions, they are complying with every single control that is written down in their procedures.
And you should totally automate that, because if you're relying on discretion...
Cable.
Oh my God.
Exactly. Brilliant.